Welcome to another exciting video of Term Insurance Must Know Guide. In the last video, we covered 8 steps to structure multiple term insurance policies smartly. In this video, we'll cover 6 signs when should you buy additional term cover as income increases. In my 25 years of insurance distribution, what I have consistently observed, you bought a term insurance plan at an age of 30, and that time say your income was 12 lakh rupees and cover you took is 1 crore rupees. Now you are 38 years of age and income is 28 lakh rupees. Question is, should your term cover increase as your income increases? Most people upgrade lifestyle but forget to upgrade protection. In this video, I will share 6 clear signs that indicate it's time to buy additional term cover. 6th sign is most important, so watch the full video. Let's start it. Sign 1. Your income has doubled. Why it matters? Term insurance replaces income. If income increases but cover remains same, your income replacement ratio drops very sharply. Say age 30, income 12 lakh rupees, cover 1 crore rupees. It's just 8 years of a replacement of income. Age 38, income 28 lakh rupees, cover 1 crore rupees, it covers just 3.5 years of replacement of income. Protection efficiency has reduced. So what is action in this case? Recalculate using 15 to 20x current income formula. Validate with HLAV method. Add additional cover. Do not cancel the old one. We have given in my previous videos that how to calculate adequate cover. You can use those formulas and arrive at the right cover amount. Sign 2. You have taken a large new loan. Loans are fixed obligations. For example, existing cover is 1.5 crore rupees and new home loan you have taken is of 1.2 crore rupees. Loan alone consumes majority of your protection. Family security layer shrinks or it goes. So what action is required in this case is add a separate loan aligned policy, matching loan tenure. You can even request to your financer also that they should give you a term cover. मोस्टली जितने भी बैंक्स हैं, फाइनेंसिंग कंपनीज हैं, होम लोन्स के साथ एक टर्म पॉलिसी देते हैं और वो उसी पीरियड तक की होती है जब तक आपका होम लोन होता है एंड दैट परफेक्टली वर्क्स फॉर यू. साइन 3. यू नाउ हैव चिल्ड्रन. चिल्ड्रन इंक्रीजेस फाइनेंशियल रिस्पॉन्सिबिलिटी. प्रोटेक्शन का ड्यूरेशन आपका बढ़ जाता है. एजुकेशन फंडिंग रिक्वायरमेंट आ जाती है. एट 25 you have no children. At 30 you have a newborn. So now have 20 to 25 years of responsibility. एक बच्चा आपका 20 से 25 साल की रिस्पॉन्सिबिलिटी है टिल द टाइम ही और शी बिकम्स अ मेजर और बिकम्स अ फाइनेंशियल इंडिपेंडेंट. सो उसके लिए आपको एक एडिशनल कवर लेना चाहिए. वो मीडियम टर्म का हो सकता है. 20 से 25 साल तक के लिए आप एक एडिशनल कवर ले सकते हैं. नॉट फॉर द एज ऑफ 60 और टिल एज ऑफ 65 टिल द टाइम द किड बिकम्स अ फाइनेंशियल इंडिपेंडेंट. Sign 4. You became sole breadwinner. Earlier, there was a dual income. You and your wife both were earning. Now you are a single income. So dependency concentration increases. Single income households statistically require stronger protection cover. So you must ensure that you are adequately covered. Calculating basis the household income and you must take cover for yourself. Increase cover beyond minimum calculation. Sign 5. Net worth increased, but liquidity is low. Say for example, your assets are not equal to immediate liquidity. For example, आपका नेटवर्थ 5 करोड़ का है बट मेजॉरिटी लॉक्ड इन या तो आपने रियल स्टेट में इन्वेस्ट कर रखा है, जहाँ लॉन्ग टर्म इक्विटी में इन्वेस्ट किया हुआ है, जहाँ ज़्यादातर एनपीएस काइंड ऑफ या पीपीएफ लॉन्ग टर्म रिटायरमेंट कॉर्पस रखा हुआ है. लिक्विडिटी अवेलेबिलिटी ओनली 40 to 50 lakh rupees. In case of untoward situation, immediate financial shock handling becomes very, very difficult. So you must take an increased cover. Hence, the action required is ensure term cover compensates your liquidity gap. Sign 6. It's been 5 to 10 years you started your job or you started earning. Age directly impacts your premium cost. You didn't take a cover. Medical underwriting, loading probability, delay increases long-term cost. For example, at age 30, your premium was X. At age 30, it could be 1.5x to 2x higher. Action: buying additional cover earlier is financially smarter. You should not be delaying. As soon as you have a responsibility, you have started earning, you must take an insurance policy to safeguard and replacement of income. Practical strategies when upgrading cover: keep existing policy, add new policy as additional layer, disclose fully again, align duration with responsibility. Layering ensures flexibility. As we have already covered in my last video, that layering helps you to save money. It directly addresses a risk of a specific event so that you are fully protected and saves money as well. Final thought, in my 25 years of distribution experience, I have seen more families underprotected due to growth than due to lack of initial purchase. Term insurance should evolve with income. It should not be like a fixed you have taken once and it remains same forever. Protection must grow with progress. If your income has grown in last 3 to 5 years, review your protection today. It's very important. I hope you like this video. Let's meet for the next video. Should you replace your old term plan with new cheaper ones? Thank you very much.